Hi, everybody. This is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 48, titled Rolling Deep Out of the Money Puts to a Higher Strike, a Viable Mid-Contract Strategy? Well, we're going to find out by using a real-life example with Nvidia Corp, which trades on the NASDAQ exchange under the ticker symbol NVDA. Let's kick off this podcast by first defining what is selling out of the money cash secured puts. Well, as with covered call writing, step one is to select an elite performing stock or exchange traded fund. Now, when I say elite performing, I'm talking about from a fundamental, technical, and common sense perspective, all three. So our enemy are share price decline. That's why we want the strongest stocks from all three perspectives. Now, once we've identified these stocks, we will then sell an out-of-the-money cash secured put. So we don't buy the stock, but we're leveraging that stock to determine which put option to sell. Now, an out-of-the-money put is lower than, the strike price is lower than current market value. But the broker, when we sell this put, is going to require us to put a certain amount of cash into our brokerage cash account. And the formula for that is the put strike minus the put premium times 100 times the number of contracts. And that will dictate how much cash we are required to put into our brokerage account to secure that put trade. Now, the stock price and the put premium are inversely related. So if the price of the stock goes up, the put premium value goes down. Now, we keep the original put premium no matter what. But if the price of the stock does go up and the put premium goes down, we can actually close it or buy it back at a much lower price than we sold it for. And this relates to our 20%, 10% guidelines for put selling exit strategies. Now, we also have 20%, 10% guidelines for covered call writing, but that's a different scenario where the price of the stock goes down. Here, the price of the stock goes up, and that relates to the fact that put premium and share price are inversely related for puts, but directly related for calls. So we're going to hopefully make this all come to life by using a real-life trade with Nvidia Corp, as of the date April 16th, 2019. Now, if we go back in time a couple of weeks, on March 29th, 2019, Nvidia was trading at 177.25. The investor from the BCI community sold an out-of-the-money 155 put for $12.07. So it was actually expiring on January 17th, 2020, 10 months out. So it was actually a leaps option. Now, I prefer monthlies, and we'll get to that later on in this podcast, but that was the case. It was a 10-month contract at that point in time. Now, what happened was just 2 weeks later, Nvidia moved from 177.25 up to 187.42, more than a $10 increase in value. Now, on April 16th, if you check the option chain to close the 155 original put sale strike and opening a 175 higher strike in the same contract expiration month, we would generate an additional option credit. And that's the reason why this investor was considering doing it. So the question becomes, what are the pros and cons of such an approach? Now, if we looked at the initial trade structuring using the BCI put calculator, based on the information that we just gave you, the current price being 177.25, and the 155 out of the money put was sold at 12.07, we would find out that the return on this option for the 10 months was 8.44%. If we annualize that out, it would be 10.48%. Now, that's pretty good. Now, you have to determine whether or not that meets what your annualized goal is for selling options. It would be a little low for me, but for some investors, that may be just fine. So that's how the initial trade was structured. Now we go back to April 16th, and we're going to take a look at rolling up the 155 to the 175 strike to generate additional option credit. Now, the cost to close, we go to the ask column at that point in time, we would see, if we looked at the option chain, a cost of $9.85. And then if we were to sell the 175 higher strike, but still out of the money, it would generate $16.75. So we have a credit of $16.75 and a debit of $9.85. So we see here $690 would be our credit, $690 per contract. Once again, with the same expiration date of January 17th, 2020. So we know now that we will have generated an option credit of $690. But there are some disadvantages to rolling up in the same contract month. First of all, additional cash will be required to secure that put. Why? Because if you go back to the formula, put strike minus put premium, we now are dealing with a higher put strike, much higher, $20 higher. So the broker will then require more cash to secure that put. As a matter of fact, if you do the math, it came out to $1,532 per contract more. So that's one disadvantage of rolling up in the same contract month. The other is, in addition to rolling up to a higher strike, the break-even will also move up. So it creates more risk because we have a higher break-even price. As a matter of fact, if you did the math, it would roll up, it would move from 142.93 to 158.25. Now, 158.25 is still well below current market value, but there is more risk in having a higher break-even price. Now, I'm not saying it's the wrong thing to do. I'm just saying that if we do it, we have to understand the pros and cons. The pros, you have an additional option credit. The cons, you have to put more cash into the account and you have a higher break-even. Now, are monthlies a better approach? I say yes. Why? Because if you annualized out a monthly return, puts or calls, you're going to have higher returns than using a 10-month option. Every single time, every stock or ETF trade, you get a higher annualized return using monthlies than you would longer-term options. Now, in this particular case, if you went to a 1-month option chain for Nvidia, you would see that a 1-month premium would be $3.85, which represents a 2.2% 1-month return, 26.4% annualized. And that compares to the 10.48% for the annualized LEAPS option return. So monthlies will give you a higher annualized return than longer-term options, in this case, 10-month option. So let's summarize. Rolling up a deep out-of-the-money put option will add additional option credit to your account, but will require additional cash to secure that new trade and the additional risk of having a break-even at a higher price. Monthly options will offer greater annualized returns than longer-term options, in addition to allowing us to reassess our bullish assumption on the stock more frequently. So those are two of the main reasons why I prefer monthlies over long-term options. Now, before I close, a reminder, which I do in all of these podcasts, there are an awful lot of free resources on our website, www.thebluecollarinvestor.com, including the free resources link on the top black bar of our web pages. We have calculators and files that you can download to your devices for free. We also have a free newsletter, which you could sign up for on the blog link of our website, and hundreds of articles available to you. In our Blue Collar Investor store, we have online streaming video lessons, ebooks, soft and hard-covered books, calculators, spreadsheets, trade planners, and online mentoring programs as well. So there are a lot of products available to you for educational purposes to help bring your returns to the highest possible levels. I want to thank you folks for taking the time to listen to this BCI podcast number 48, Rolling Deep Out of the Money Puts to a Higher Strike. I hope it gave you the information necessary to determine whether or not this is an exit strategy you want to incorporate into your trading approach. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.